topic for today is financial management. Here there are two concepts, namely finance and management. Finance means money. Money means what money does. Without finance, it is very difficult to organize a business or to run the business effectively. Finance is the lifeblood of any business organization. Finance is essential not only for the large scale organization, but also it is essential to small scale, medium scale organizations. Finance means at what time it is provided to the organization, which means it is to be provided when it is needed for the business. Finance is also termed as science of money, which means the finance is considered to be the scientific activities involved in the financial resources. That is, the funds must be borrowed scientifically as per the plan, and it is to be used effectively in the organization. The funds must be channelized through all the parts of the organization. Then only it will be more effective for the purpose of running up of an enterprise. Finance is also called as the provision of money at what times it is wanted or it is needed. That is, the funds must be supplied when it is required for the business. And then another concept, management. Management is nothing but effective administration of funds. The funds which are borrowed from various sources must be effectively utilized for the running up of the business. Therefore, it is nothing but the financial management is nothing but the area in which the funds must be effectively utilized, or effective utilization of funds in different parts of the organization. The main objective of the financial management is to profit maximization and wealth maximization. The profit maximization concept is a classical concept. It is nothing but the increasing the profit of the business every year, or increasing the profitability of the organization in the years to come. In the case of wealth maximization, is nothing but increasing the wealth of the organization, or otherwise called as increasing the trustworthiness of the business. The total wealth of the business must be enhanced over the number of years. That is, there are certain differences between the profit maximization and wealth maximization. Profit maximization is only, it refers to earning the profit or seeking the profit in an organization, and the profit refers, whether the profit refers to short-term profit or long-term profit, or the profit is before tax or after tax. All these factors are not considered in the case of the profit maximization concept. But whereas in the wealth maximization concept, all these factors are considered. The funds which are borrowed must be effectively utilized over the number of years, with which the wealth of the organization must be enhanced. That is, there is a formula to calculate the wealth maximization. W is equal to A1 divided by 1 plus T plus A2 divided by 1 plus T to the power 2 plus A3 divided by 1 plus T to the power 3 dash 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 plus AN divided by 1 plus T to the power N minus C. So this is the formula to calculate the wealth maximization of the business. And then the funds can be borrowed in different agencies or different sources. namely the funds may be borrowed from the borrowed for the business according to the requirements of the business. In the case of the organization, the funds may be required either in short-term requirements or it may be long-term requirements. Short-term means the funds which are borrowed, which is required for short period, for less than 1 year. For example, for the purpose of manufacturing expenses or meeting the day-to-day expenses, the funds are borrowed. In this, short-term funds are borrowed. In the case of long-term funds, the funds are borrowed for the purpose of the long-term requirements of the business, namely purchase of land, building, plant, machinery and other fixed assets. So for which we have to borrow funds for more than 5 years, that is from different agencies like banks, financial institutions and other organizations are coming forward and providing long-term finance to the business. So both short-term and long-term funds are essential for the business. And then in the case of financial management, it refers to different decision making, or financial management requires the different decision making areas such as number 1 capital budgeting decision, number 2 the investment decision, third one is financing decision, fourth one is the working capital decision, and the last one is dividend policy decision. The capital budgeting decision means the total amount of capital must be, or capital is invested in various assets like plant, machinery, purchase of long-term assets such as buildings, and then construction of work shed, etc., which are essential. And the funds are actually used for the purpose of construction of a project, etc. Then for which the funds are borrowed and it is to be invested in long-term in a long-term manner, and at the same time the funds borrowed must be effectively utilized in the long-term projects. And then the capital budgeting decision is nothing but the decision which refers to the whether the funds is invested in the business, whether it gives profit, adequate profit or minimum rate of return for the investment. And then the funds, once in the funds are invested in the initial project, and see that the funds are actually received over the number of years. That is, it requires a long-term decision. The initial years, the funds must be invested on a long-term basis. That is for 10 years or 15 years. But at the time of the initial investment, and then the return will be received over the number of years, but not at one point of time or few points of time. It will be received over the number of years till the existence of the fixed assets. And at the same time, the money value will be decreasing over the number of years. So such a type of decision is what is called capital budgeting decision, for which we have to see that the fixed assets are to be purchased or to be borrowed from, that is on leasehold basis, or the assets are to be purchased on second-hand assets, etc. So such a type of decision is what is called capital budgeting decision, for which there are different techniques are available to find out the profitability of the project, namely payback period method, and then IRR method, ARR method, that is average rate of return method, internal rate of return method, net present value method, and then net present value index method. These are all the methods available for the purpose of knowing the profitability of the project. Then another decision is what is called a investment decision. Investment decision is nothing but the funds borrowed must be properly invested in different assets or different form of requirements of the business. That is, it may be short-term requirements or it may be long-term requirements. So while borrowing the funds must be borrowed from different agencies, like issue of shares or issue of debentures or by way of borrowing loans from commercial banks, financial institutions, etc. And then the funds borrowed must be effectively allocated for different purposes. And then then only the business is able to get profit. If it is kept idle, it will not yield any return. That is why the investment decision is very essential for the organization. Then third one is what is called the working capital decision. Working capital decision is nothing but the decision regarding the working capital requirements of the business. The working capital requirements may be different from one organization to another organization. The working capital requirements is more in the case of the manufacturing business, but it may be less in the case of the service sector industries. Therefore, based on the requirements of the business, we have to identify the working capital requirements of the business. And then next one is financing decision. Financing decision is nothing but the decision regarding the composition of different security mix in the total capitalization. That is the proportionate securities such as the equity shares, preference shares, debentures. So what are the different proportions which are required for the purpose of financing, with which we are able to get more return on those assets or on those securities. So such is decision is what is called that is financing decision. Last one is dividend policy decision. Dividend is nothing but a portion of profit which is distributed as dividend to the shareholders, and then the dividend is to be distributed only based upon the legal requirements of the business. That is, as per the provisions of the Companies Act, the dividend must be declared to the shareholders of the business after setting aside the various requirements, or for the purpose of adequate depreciation for the assets, or the dividend shall not be declared from the capital profit of the business. So we have to look into the various legal aspects regarding the declaration of dividend. Then the remaining portion can be distributed as dividend to the shareholders. The dividend may be that is distributed by the that is board of directors only in the annual general meeting. Board of directors have got the powers to distribute the dividend or not. They are having the prerogative rights to declare dividend to the shareholders. The shareholders are that is getting the dividend only after announcing the dividend declaration only in the annual general meeting. Then the dividend is distributed to the shareholders based upon the liquidity of the business, liquidity requirements of the business. And then not only that, but also if the business is having future plan for expansion and development activities, that they can retain the business. Or if there is no such plan for the future expansion or development, that is, dividend can be retained within the organization. If there is no requirements, the entire amount can be distributed in the form of dividend to the shareholders. So such a type of decision is what is called a dividend policy decision. The policy may be differ from one organization to another organization. It depends upon the nature of organization. Then the policy of decision may be of stable dividend policy, optimum dividend policy. So these policies are followed by the organization depending upon the availability of the funds or liquid funds available in the business. So these are all the various decisions normally undertaken by the business for the purpose of financial decision. So financial decision making is a very important decision which are very essential for the purpose of effective utilization of funds in the organization. That's all about this introductory part of the financial management.